Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 23rd of January 2022. And we are looking at what is likely to happen on Wednesday when the FOMC of the Federal Reserve in the United States makes its announcement on interest rates. And we've seen today an article published by Simon Kennedy in Bloomberg highlighting the fact that Goldman Sachs sees risk Fed will tighten at every meeting from March. And we thought we would go through this article because it's actually quite comprehensive and an interesting take on what one of the major financial institutions of the world envisages will happen. Goldman Sachs Group, Inc. economists said they see a risk the Federal Reserve will tighten monetary policy at every policy meeting from March, a more aggressive approach than the Wall Street Bank currently anticipates. The Goldman Sachs economists, led by Jan Hatzius, said in a weekend report to clients that they currently expect interest rate hikes in March, June, September and December, and for the central bank to announce the start of a reduction in its balance sheet in July. But they said inflation pressures mean that the risks are tilted somewhat to the upside of our baseline, and there is a chance officials will act at every meeting until the inflation picture changes. This raises the possibility of an additional hike or an earlier balance sheet announcement in May, and of more than 4 hikes this year, the economist said. We could imagine a number of potential triggers for a shift to rate hikes at consecutive meetings. Chair Jerome Powell and colleagues meet this week amid expectations they will signal a willingness to lift rates from near zero in March. Fed rate liftoff is likely in March, and rates may rise gradually in 2023, and this is what they're predicting. You have rates in January, 0.3, rising to 0.5 in March, to 0.8 in June, to 1 in September, maintaining 1 December because 4 will have been achieved, then rising to 1.5 by June 2023, then 2% during 2023 and into 24, and then rising to 2.3 by the end of 24. Now, we have already indicated that whilst we would probably agree there could very well be 4 rate hikes this year, rising more than 1% is very unlikely. Not totally out of the ballpark, but very unlikely nevertheless. With inflation in the US at or around 7%, something has to be done in order to curb it, and even, to be frank, a 1% interest rate is going to have a very limited effect. In addition to that, of course, we all know, because of the extent of the public finances and the national debt, you only have to look at the US debt clock, and we can see at the moment the US debt is just shy of $30 trillion. So, of course, the days of interest rates being at 5%, 10%, and goodness forbid 15% are over. And perhaps the best the Fed will ever likely achieve without actually causing virtual government collapse is about 3% at best, and we envisage 2.5% is really where the peak lies. Let's continue with the article. Among potential spurs for even tighter policy would be a further increase in long-term inflation expectations or another surprise on inflation, the Goldman Sachs economists said. They noted they had already been made more concerned about the inflation outlook by the arrival of the Omicron variant and continued strength in wage growth. Now, this continued strength in wage growth is something that we've noticed even in the United Kingdom, where people are beginning to complain that even though those in work have had potentially higher wages so far, it's nowhere near the current rate of inflation which for us currently is above 5%. So economies around the world are facing this dilemma of having rising inflation, a limited ability of the central banks to raise rates, which they will do, be of no doubt about that. But it will certainly hurt people financially when that occurs, particularly those who were hard stretched to begin with in taking out various forms of mortgages at current low rates and personal loans. In addition to this, we have another problem, and that's highlighted in the next article. What would war in Ukraine mean for Europe's energy crisis? That Joe Biden has already stated at a press conference that he potentially can expect some form of military intervention by Russia into the Ukraine. And of course, the knock-on effect of that is, we'll just read a very small part of this. How hard will energy-starved Europe be hit by a potential Russian invasion of Ukraine? It depends on how President Joe Biden reacts. Russia kept sending gas to Europe all through the Cold War, and more recently in the aftermath of its annexation of Crimea. Moscow is unlikely to want to risk damaging its reputation as a reliable supplier this time around either, according to Uniper SE, one of the top buyers of Russian gas in Europe. But Biden has warned of severe economic restrictions if Russian troops cross into Ukraine. One big risk to the flow of gas to Europe would be sanctions, either cutting Russia off from the ability to trade in foreign currency or other restrictions on its banks. We have to prepare for almost every scenario, Gregor Pett, Executive Vice President of Market Analytics at Uniper, said in an interview. Here's a look at just what those scenarios could be and what they could mean for a continent that depends on Russia for about a third of its gas. Europe is already reeling from the worst energy crunch since the 1970s, with gas stockpiles running perilously low. Prices have more than doubled in the past 6 months on fears of war and capped shipments from Russia, even as President Vladimir Putin has repeatedly said he doesn't plan to invade Ukraine. Now, we won't go any further, but without a doubt, with inflation rising, any reduction in the gas supply will cause prices to go even higher, causing greater inflation, putting more pressure on the central banks. How this pans out remains to be seen, but with the Omicron variant still spreading, fortunately, its effects seem to be limited compared to previous variants. It could indeed be folly for any government now to suggest further lockdowns or to reduce what little entrepreneurial spirit there is left in the global economy. We've already seen through previous videos and currently announced in our weekly update published yesterday that the economic figures are not tremendously exciting or prosperous, and any further damage of those will result in a severe lack not only of GDP growth, but a crushing of our existing standards of living. What will the Fed do on Wednesday? They will tighten, because inflation at the moment is the greater enemy. But that tightening will be limited. However, the talk, in our view, will be hawkish. Another factor, and a final one to bear in mind, is the equity market. In the equity markets, we have seen significant falls in recent weeks, and the Federal Reserve will be loath to add to that pain. Yes, markets are still not that far off their all-time highs, but with monthly changes of between 5 and 12%, further reductions can only go on for so long before the effects filter through into the ability of companies to raise more money and to invest further. The Fed has a very difficult balance on Wednesday, and we shall see from their rhetoric how successful that balance is maintained. What do you think? Do share your thoughts. Please give us a thumbs up, subscribe, press the bell sign, and before next Wednesday, we'll continue on the theme of what is likely to happen as a result of the FOMC's statements. In addition, we will of course be producing our morning updates. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.